Capital efficiency in strangles. Let's take a look. Do you think there's a certain delta strangle that is the most capital efficient?
I wouldn't think so, because the closer you get.
I'm surprised you say that.
Why?
You don't think that there's certain deltas that are more capital efficient than other deltas and more that provide better returns? That you could hold it. If you were to optimize,
use more capital and get more premium
if you were to optimize, best bang for your buck.
Well, sure, there's going to be an optimal, and that's just because of the volatility of the product and staying at or around an expected move.
Best bang for your buck, what delta?
Well, it's going to be somewhere probably around the 20-ish delta to 30-ish delta.
We usually prefer selling out of the money strangles over straddles for a variety of reasons.
But you only go up by a couple of $100 the closer you get. Now, you may take a lot more risk for that, so that's why I say optimal is a hard word.
Don't make me bring in Dr. Jim to explain this to you. We usually prefer selling out of the money strangles over straddles.
Don't make me quit again.
For a variety of reasons that include better risk reward, less portfolio volatility, more flexible management. Of course, if you're taking less risk, you're going to be more flexible because it's not going to be trouble as much. Less portfolio volatility, less swings, better risk reward. Well, we got to learn that. So today we're going to explore another reason, which is capital efficiency. One of the things that we like to do at Tasty is to optimize. All we can really do with our research is optimize the mechanics. So in other words, do something at 45 days, adjust it at 21 days. That's optimizing the mechanics. How about picking the right delta for a strangle? That's optimizing mechanics. That doesn't mean if you do 50 deltas or 35 deltas or 25 deltas or 10 deltas, you're being theoretically disadvantaged. Doesn't mean that at all. It just means if you pick the perfect delta, you're optimizing your mechanics. So capital efficiency is measured by how much you can make per dollar you invest. For example, return on capital. So what does return on capital look like for different delta strangles? So we look at return on capital, the theoretical, and then we say that equals the credit divided by the buying power reduction. So then we looked at 14 years worth of data. This is all during a bull market, okay? We are what we are. 45 days to expiration, we sold the 10, 16, 20, 30, 40, and 50 delta strangles. You see them all up there?
I do.
You want to change your
from my 20-ish delta?
Yes, if you change that you're probably have a better chance of being successful.
Yeah, but I'm dealing with somebody who's not real successful. So I'm going to stick with my 20.
Managed at 21 days and held to expiration. We recorded the average return on capital and the average P&L over the credit received. So when simply looking at theoretical P&L, theoretical return on capital, it seems more capital efficient to sell the highest delta strangle possible.
Which was my point when you asked the question.
If we're looking simply at theoretical.
You asked the question, that was the way you asked the question, and that's why I answered the way I did.
So when simply looking at theoretical return on capital, it seems more capital efficient to sell the highest delta strangle possible. But this can be misleading because even though straddles are more efficient credit-wise, that means they take in more credits, it doesn't mean your profits are efficient. So by looking at the actual return on capital rather than the theoretical, we can see that our historical performance relative to our capital usage, okay? So we divide P&L by BPR, we get an actual return on capital. When we're looking at theoretical P&L, we're looking at the credit divided by the BPR, okay? That's the credit. That's how much money we take in. When we jump back up, the actual return on capital is P&L divided by buying power reduction, which this is what everybody wants to see. So we look at the actual return on capital, we can see that historical performance relative to our capital usage, right? Because that's what actual is. This is cool because this is like implied versus realized volatility. So now when we see this, that bottom line is delta. Hopefully everybody can see the delta on their screen. So now it's more clear that selling straddles is not nearly as efficient as it may seem. In the last 14 years, drum roll please, the bat was right. The 20 delta strangle has been the most efficient. You see it on here at 20 deltas? You can see anywhere between the 16 and the 20 delta.
April 15th will live in infamy now because I was right. No longer are they do with taxes.
Well, knowing you probably read this in advance or something.
Yes, yeah. Anton gave me the answer or whatever.
Oh, your Anton gave you the answer? Or your wife gave you the answer?
My wife gave me the answer. She's going to explain it to you on Sunday.
She texted you. Yeah, I sent this to her in advance so she could proofread it. So in the last 14 years, the 20 Delta has been the most efficient. So there you go. Now, listen, what is Tasty about? I'll repeat what I said earlier. Tasty is all about optimizing mechanics. So we're not about optimizing theoreticals. We're not teaching you something that nobody else in the world could figure out. Everybody has an opportunity to figure out theoretical return on capital. But we like to optimize actual return on capital. And that's what this is. It says the 20 Delta. Beautiful. That's good stuff. Takeaways. Return on capital comes in two forms. And analyzing both is critical or is crucial to understanding efficiency. Though you get much more credit per capital with a straddle, the 20 Delta Strangle has the highest profits per capital. So it's the most efficient historically, if we measure historically by the last 14 years.
Good job out of the team.
Yes, very good job. That's a great piece.
Good job out of the bat.
Yeah.